This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Approaches to corporate governance. Let's start. Two distinct approaches. I've talked generally or briefly through this heading. Two distinct approaches, rules-based and principles-based. Rules-based is the one that the Americans have, Sarbanes-Oxley, and the principles-based is the one that the UK and most of Europe apparently adopts, and that's the combined code or equivalent. I read the other day that the Baltic states, you know, the Estonia, Latvia, Lithuania states, that they are or they have in the recent past adopted principles of corporate governance applicable to their governmental departments. There was, I know for a fact that there was a corporate governance code being drafted, I think it was in Lithuania, and it was meant to be adopted by the three presidents when they had a meeting, I think at the end of July. Whether it was adopted or not, I don't remember reading. So the rules-based approach, this is the American version, is one way, but the way that the UK and much of Europe and I believe the Baltic states are adopting the principles-based approach. Characteristics of the rules-based, it's a prescribed set of corporate governance requirements. It says this is what you do, these are the rules. It's a quick way of ensuring compliance, because if there is a rule you can decide whether it's been broken or not, and it's a quick and easy way to determine compliance. But you know, one of the characteristics of being a person is that, and you must have done this yourselves when you were at school, certainly when I was at school, there was a rule that said you mustn't run in the school corridors. Did you have the same rule? You mustn't run from one room to another? Yeah, you did. And that means you never ran. Is that right? You never ran? No, it doesn't mean that at all. Because the rule is there. We have the expression, a rule is there to be broken. And certainly, I had to wear a cap. My school uniform involved wearing a cap on my head. But as soon as you got anywhere near out of school or out of sight of school, the cap came off. I had to wear it all the way home. That was the school rule. You had to wear your cap all the way home. But as soon as you're out of sight, you take your cap off. Well, it's the same with this. If you set to establish a set of rules, then they're there to be broken. And people, as a natural thing, they will. I read a lovely article by a host of a chat show in the UK, and he remembers quite clearly that he went in a hospital only as a 14, 15-year-old boy, and he's had an operation and he had to stay in bed. So obviously when he needs to go to the toilet, you've got to bring the equipment along. And he went to the toilet, and the nurse said, "Have you finished?" He said, "Yes, I've finished." So and then the alarm bell went, and the nurse said, "Oh, I've got to run, I've got to rush off." So she put the pan that he'd done his natural functions in, she put it on the end of the bed, and she said, "Whatever you do, don't kick the pan off the bed." And he says within her being no more than 5 meters out of the door, he'd kicked the pan off the bed because he'd been told not to, so he did. So it's a natural thing for people specifically to break a rule or break an instruction. And this is one of the problems, I think, that the Americans are likely to have. You establish a set of rules and people will then try and find ways of breaking it. We had a DJ on the radio, and we've got an old, very popular singing performer, a man called Cliff Richard. And this DJ, every 2-hour show that he did, he would always play 2 or 3 Cliff Richard songs within the 2-hour show. And he got an instruction from the BBC authorities, and the BBC said, "No more Cliff Richard. We've had enough now, Cliff. No more Cliff Richard in your 2-hour show." So he went in the next morning, and what did he do? He played 2 hours of Cliff Richard. 2 complete, solid hours of Cliff Richard songs. It was totally against this direct instruction which had been given by the governors. And people do. Rules-based approach adopts a checklist approach. Have you done this? Have you done that? Did you not do this? Did you not do that? It's a checklist, so it's a quick and easy way of ensuring compliance. There's a clear distinction between compliance and non-compliance, and it's easy, therefore, to see. There's a reduction of flexibility. Now, I don't know whether this is an advantage or a disadvantage. A reduction of flexibility on the part of management and auditors. That if there is a rule, then there is a rule, and that rule shall be followed. So there's no room for saying, but in the circumstances, this is the better thing to do. So this reduction of flexibility, I could see quite easily that could be claimed as a disadvantage. It's difficult to set rules to cover all situations. That is a problem. And it's possible to misinterpret rules. To misinterpret anything. If you write anything down, it's capable of misinterpretation, particularly with the importance of inflection in your voice, with breaks between two consecutive words. I was listening to a Rolling Stone CD on the way up last week, and there's a record, a track on the disc called Don't Stop. And I'm thinking, well, I could interpret that in two ways, as in don't stop, or don't stop. So just by putting the break between the don't and the stop, it's a completely different impression of what the instruction or the rule is. Don't stop is completely different than don't stop, isn't it? So possible to misinterpret rules. And the same rules apply to all, whatever their size. And again, it's one of the problems with audit programs. When I was a trainee, we had a standard audit program, and every time you went to a client, you took the standard audit program with you, or the standard internal control questionnaire, and it just didn't apply. It developed, because then we developed different programs for different types of business and different types of industry. But a standard set of rules like this can't apply to all companies because of the different size, because of the different specializations, the different situations that they have within the marketplace. And then over the page 10, the characteristics of the principles-based. And of the two, I'll say now, of the two different approaches, it's my personal preference, but it is a personal preference, that the principles-based is the better approach. I prefer the principles-based. You can make your own decision. Activities of entities must address major principles set out in codes of best practice. But these are principles. These are not laid down rules. These are objectives rather than specific statements. So we should aim for honesty. We should aim for fairness. We should aim for transparency. But then there is this degree of flexibility available. I'm aiming for transparency. I may not make it, I may not achieve it, but I'm trying to get there. I may try to exercise independence in any decision making, but there are situations when I may not be truly independent. So it sets out principles rather than rules. It's not simply then a box ticking exercise. But it is more difficult to avoid than a rules-based approach. Why? Because the principle is a principle, and you aim to achieve that principle, but you can see when you deviate away from trying to get to that principle. You can see the difference between honesty and dishonesty, accountability and not accountability. You can see that there is a difference. So it's more difficult to avoid. If you set a general principle that says you will be a clean living person for the next 10 years, then you know that you're not being a clean living person if you're not. So it's difficult to avoid a general principle, whereas it's more easy, I would suggest, to avoid a specific rule. It's easy then to see that the company is complying because any breaches of the principle should be reasonably apparent. Directors are required to work in the company's best interests. Well, yeah, that's a general principle, isn't it? Generally, we expect directors to work in the company's best interests. But if they don't, and if by their actions it would seem that they're working more in their own interests at the exclusion of the company's interests, then they're breaking the principle. It's more flexible and therefore better able to deal with new or unusual situations. And it's more flexible, and that therefore means it's capable of applying the principle to any organization, whatever the size of the organization. The principle is still the same: accountability, honesty, reputation, and so on. It's easier justification for apparent breach of principles. This is a disadvantage. Because it's more flexible, you could possibly more easily justify this move away. I'm aiming for transparency, but in this particular situation I couldn't achieve it. And principles may be interpreted differently. It's easy to interpret anything in a number of different ways. It just is easy to do. These principles, these characteristics of corporate governance, I forget what the characteristics of corporate governance, or what the elements of corporate governance are. Can you help me here? What are the elements of corporate governance? Who? Hairdrift, yeah, okay, but it's no good writing hairdrift in the exam. You need to make 9 paragraphs out of it. So go on then, start me off.
Honesty.
Honesty. What's another word for that? Another word for honesty?
Tell me, please.
Probity.
Probity.
What's the A?
Accountability.
What's the I? Can only be one of 2 things. Who? Just give me one.
Integrity.
Integrity. R?
Our reputation.
All right. D?
Decision making.
R? She's taken reputation. Oh, now we've got the other. Go on then.
Our responsibility.
Responsibility. I? We've had integrity. Think of Ilse. And Ilse's main characteristic, the major characteristic of any auditor: independence. F? Fairness. T? Transparency. Okay. Now I want to subdivide stakeholders into various categories. How could I do that? Pink lava. So give me the pink lava then. P? P? Primary or secondary. I? Internal, external. N? K? Known and unknown. L? Legitimate and illegitimate. A? Active, passive. R? V? Not R. V? Voluntary and involuntary. R? Recognised and unrecognised. No, just go back 2 hours and ask yourself how much of that you knew before 9 o'clock. Ask how much it's changed your life. But principles may be interpreted differently. This is one of the problems of a principles-based approach, that they're capable of different interpretations. Approaches the arrival of corporate governance, the headline hitting failures in Europe, the UK, USA. It's interesting how I've put UK there as not being associated with Europe. In Europe, the USA and the UK. There was a famous headline in newspapers a number of years ago now, when there's a big fog, you know, fog, a big fog in the English Channel separating France from England. And the headline in the newspaper says, "Fog in Channel, continent isolated." It didn't say that the UK was isolated from the continent. From a British perspective, the continent was isolated. It's a recognition of the need of some sort of control. How would you define corporate governance? Give me a definition, a one-line definition of corporate governance. Oh, come on, ladies, you can do it. Any of you gentlemen?
The relationship between...
No, it's a system whereby a company is directed and controlled. A system by which a company is directed and controlled, or by which entities are. Common elements identified within this corporate governance, within the failures, I should say. Common elements which were identified primarily in the Cadbury report in 1992. And he said that common features of this failure and that failure and that. The common features were these. Poor entity management by directors. The directors of the company managed the company poorly. And tied in with that, there was typically a single dominant individual at the head of the company. Someone maybe at the head of your national airline, someone who has major power when compared with all the other directors. I've got in my mind a man called Robert Maxwell. Robert Maxwell was the chair and chief executive of a company called the Daily Mirror Group, or the Mirror Group. And his two sons were also on the board of directors, and that also is a questionable activity. To appoint people who are closely related, it does then give you more power. If I were to appoint my wife to the board of directors, the two of us combined have got greater power than the sum of the individuals, because two people acting together on a regular basis will often defeat the wishes of others, even the wishes of three others. It only needs one of the three to vote in our favour. So single dominant individual. Robert Maxwell was such a person. He was a dominant individual, and he didn't stand any nonsense. If any director or employee or manager were to argue against him, that was it. They were out. They were finished. No more promotion, maybe not even any more job, no more salary, no more benefits, no more bonuses. So this dominant individual was, not only was he king of the castle, but he was the king and all the courtiers and all the important people within the castle, and you just don't stand up against a person like that. There's a Turkish Cypriot, a man called Azil Nadir, and Azil Nadir was in charge. He was chief executive and chairman of a group called the Polypek Group, which were manufacturers of women's clothing, basically. And he was again a dominant individual, and people would not stand up against him. People would not argue. People would not say, we really shouldn't be doing this. And he would make a decision, a unilateral decision, and then tell the board, this is what I have decided the company is going to do. So this single dominant individual, and the company went into major liquidation. This single dominant individual is a common characteristic, a common element of a high-profile corporate failure. Unreliable financial reporting. And I don't know who you can blame for unreliable financial reporting, but I wouldn't blame the auditors. Maybe the auditors should have suspected that the financial reporting was being unreliable, but unreliable, the adoption of creative accounting principles, distortion, manipulation by the directors and particularly by Chief Financial Officer, then the financial reporting common to all of these failures was, or has to be seen as being unreliable. I'm thinking again of Madoff, the American, the New York guy, who swindled, who cheated his investors out of, I can't remember the figure, something like $80 billion. It was just some phenomenal amount. And his auditors was one man in practice on his own in a rented office in a back street of New York. Not one of the big four, he was just a single man with no employees, just a man in a sole practitioner. And he's auditing an organization with $80 billion worth of apparent assets. Unreliable financial reporting. And the people who are investing, if they had done any research at all, they would have seen the financial statements, they would have seen the auditor's name, and they would have said, I've never heard of this person. This is an $80 billion company, and it's not being audited by one of the big four. So unreliable financial reporting is a common problem within these corporate failures. Ineffective internal controls, and this is where the auditors come in with their major recommendations and their constructive criticisms, recommending changes to internal controls. Ineffective internal controls will probably, potentially, lead the company into a disastrous situation. Incompetent directors, people who are directors of the company, and they lack competence. They've been appointed because maybe they're a friend of the chief executive, maybe they're a golfing partner of the chief executive, maybe they went to the same school together and one of them is now out of work, he's looking for some gainful employment, and he says to his friend, Do you know any positions available? And he says, yes, come and join the board of directors. Incompetent directors, people who just do not have the skills. I heard on the radio last week, I wonder what the context was. The question by the interviewer was that, are we developing in the UK chief executive officers, we used to call them managing directors, are we developing in the UK chief executive officers who have the competences to run big companies? And the man that was being interviewed actually runs a training organization to teach chief executives or potential chief executives. And his response said, he thinks that of all the people that come on his course and qualify and become chief executives, he reckons that up to 2/3 of them are not competent. They don't have the skills to be able to do it. That's frightening. I don't know what it may be like in your country, but 2/3 of chief executives are incompetent. You auditors will come across this, I presume. I presume. Lack of close involvement of institutional shareholders. You buy a big investment in a company, but then don't do much with it. You don't get closely involved. You don't meet the directors on a regular basis. You don't influence, you don't contribute to discussions about strategy and about the long-term future. You've made a major investment, and then traditionally these investors would sit back and just let the company carry on and hopefully continue to make profits. But then they didn't make profits, they made losses. So lack of involvement of institutional shareholders. This comes up, you know, in the exam questions. It comes up on the basis of what could this organization do, or what could it have done better? Directors are interested more in the personal position than in the welfare of the entity. Of course you are. Of course you're interested in your personal position. That's what directors do. That's what they are. And you can't fault it. You can't fault it. Why would a director consciously not put the company into a position which he should put them into? Why would a director put the company into a losing position because that may be the right thing to do, when that will also mean he's potentially losing his remuneration, his job? They wouldn't do it. It goes totally against human nature.